So let's say you have $10,000 and you're trying to figure out where you can park that money to try and earn more money from it. So there's generally two options most people will tell you. The first is consider putting it into a high interest savings account with, say, someone like Commonwealth Bank, earn about 2% interest rates, and you'll have whatever you put in plus a little bit of interest at the end of it all. Or you can decide to put into the share market where you can buy shares in, say, a company like Commonwealth Bank and try and earn dividends and a capital gain from it all. And those are generally two options most people will tell you if you had to consider what to do with $10,000. Now, when it comes to investing in the share market, there's generally two ways you can earn money. The first way is where you buy at a low price and you sell at a high price. So you buy your shares at $5 a share, the share price goes up to $10 and you sell it at $10 a share, you've doubled your money. Unlikely to occur for most people, but it can occur. The other way to earn money through the share market is where you earn it through dividends. And this is where a company which you own shares in makes a profit and they decide to pay out a certain portion of that profit as dividends to you, the owners of the company. Now in Australia, an example of a high-paying dividend stock is actually banks. So this is interesting because you can basically now decide to either put your $10,000 into savings as a customer with Commonwealth Bank, or you can decide to buy shares in a company like Commonwealth Bank and earn dividends and, say, capital gains from it all. So in this video, I'm going to look at what would happen if you had $10,000 and you decided to put it into, say, a high interest savings account with Commonwealth Bank, or if you had decided to put that $10,000 into buying shares with Commonwealth Bank and seeing how the amount of money you would have earned from all of that would vary over time. But we're going to use about a 5-year time frame as an example. So let's start by looking at what's on the left-hand side of the column. So you've got bank savings as a customer, and this is using an example of putting $10,000 into a savings account, say in 2016. You're earning about 2% interest rates, and what would you have at the end of it all? You'd have $11,051, and that will be made up of $1,051 in terms of interest you would have earned in this bank account, and the $10,000 you would have started with, the capital amount you had put in. So let's jump across to the bank dividends column, where we can see that the total value of the money you would have would be less. It'd be $10,975. Now this isn't necessarily the end of the world. Let me break it down for you. So the income component, which is dividends, would be $2,511. So that's how much money you would have earned in dividends by buying and owning shares of Commonwealth Bank back in 2016 and over the last few years. You would have collected $2,500 in dividends. So that's more than double you would have gotten in interest. However, the capital value, so the amount you had initially invested, the $10,000, would now only be worth $8,400. So you would have lost money. And this is generally going to be because the value of your bank shares went down in value, mainly because of COVID and various other factors that may have occurred. So that's why the total amount of money you would have as a bank shareholder would be less, the total value would be less, because even though you had earned more money in terms of dividends, the value of your initial investment, the $10,000 you had put in, would have dropped by $1,500. And when you add that together, that would end up you having less value in terms of money than the $11,000 you would have had if you had put your money into a high interest savings account. Now, just going down the table, I'll just clarify what I meant by ease of access. Ease of access for your savings in your bank account is pretty straightforward. All you have to do is transfer your money between. Some banks will have limitations in terms of if you decide to take money out of the account, they will penalize you and not give you your high interest rate. So in terms of bank shares, I would also say these are quite high in terms of your ease of access because it's quite easy to sell bank shares. They're quite liquid. Everyone's always trying to buy or sell these kind of shares, and it'd be quite easy to try and liquidate your holding. The only thing is you would have to wait a few days after you had sold your shares to wait for the money to transfer, but also you may not necessarily get the $10,000 you had initially put in. It might be worth more or less. So in terms of what are the things that actually the levers or the factors that can impact how much money you would have when it comes to bank savings is purely based on the interest rate. So regardless of which bank you put your money into, it's the interest rate that that bank is offering that will define how much money you'll have at the end of it or how much money you'll earn in it. Now, when it comes to bank dividends or holding banks as shares, the two components that would impact how much money you would have at the end of it all or during it, if you want to keep your money in your shares over time, would be both the dividends and the performance of the share price over time. Now, there's a few more things to consider, so let me just start by breaking down what I meant by these two components in terms of how you've earned your money. So let me jump across to this next chart where I've tried to show what would happen to your money over time with, say, a savings account. So if you had $10,000 you had invested, you earn about $1,000 in interest, and at the end of it, you have $11,051. Now let's jump across to what would happen if you had put your money into shares. So say you had put $10,000 into shares, you'd get about $125 in shares of Commonwealth Bank back in 2016. You'll earn about $2,500 in dividends. But if you decided to then sell your shares, say around now, 5 years later, you would have lost about $1,500 in terms of capital losses, or the loss that would come from selling your shares which are now worth less in Commonwealth Bank. So overall, you would come out with $10,975. But the key thing to call out, that number is only lower because the value of the shares went down. Now, the value of the shares can be higher or lower. And what I mean by that is if you look at the share price of Commonwealth Bank, this is how the share price of Commonwealth Bank has fluctuated since 2016. So it was around $85 at the start of 2016, kind of wobbled down to $70, up to $85 again, all the way down to $65 at one point. It got to a high of nearly $90 just before COVID hit. Then COVID hit and it went down to $60, and it's kind of recovered around that $67 mark. And this is the thing where the amount of money you would get in returns for, say, your holding in Commonwealth Bank would vary a lot depending on when you decided to sell your shares, if you had decided to sell your shares. And I'll come back to that later. But say, for example, you decide to sell your shares when shares at Commonwealth Bank were actually worth $90, then you'd still get your $2,500 in dividends, but you'd also get an extra nice little bump because you made a little bit more money in terms of a capital gain, because you bought at a lower price and you sold at a high price. So you now had $13,000 compared to, now let's say if you had bought your shares still in early 2016 and you had sold them at the bottom of, say, this whole COVID journey where they went down to $60 at one point. That's an interesting situation where the amount of money you would have earned in dividends would have been cancelled out by the amount of money you would have lost in terms of your investment in Commonwealth Bank, because the value of Commonwealth Bank shares went down by actually the same amount of money that you had earned in terms of dividends. So you'd come out with $10,000. So it's the equivalent of putting $10,000 into a bank account, coming back 5 years later into a high interest rate bank account, coming back 5 years later and finding you still only have $10,000 in there. But what's actually happened is you've earned money and then you've lost money because the value of your shares went down. Now this is quite interesting because the whole reason I put this all together was because I wanted to actually see how much money you could earn in terms of dividends versus how much money you would earn in terms of interest rate as a bank customer. So being a shareholder versus being a customer of Commonwealth Bank. And I can see already, and you guys can see already as well, the income component is much higher. You're getting more than double the amount when you're a dividend holder or you hold shares in terms of Commonwealth Bank. But the risk you run is that value of your capital investment could be higher or lower than what you had initially put in. Now, if you're going to hold bank shares for, say, a long period of time, then it actually works out okay, because generally over a long period of time, the share market goes up and companies like banks would generally go up over time. Now, the past isn't the best predictor of the future, but in this case, generally the price of the stock market goes up and banks are quite steady members of the stock market and they'll probably go up over time as well. And that's the key thing is, if you want to hold money for a long period of time, you're probably better off putting it into something like the share market where you can earn high rates of dividends, not necessarily with banks, you can find other companies as well, but you have to be comfortable or be aware of the risk that your initial investment dollar amount might not be worth as much, and that might cancel out the gains you get. And this is where I'd call out the value for the bank dividends column, the whole $10,975, is highly dependent on the value of Commonwealth Bank as shares. And it's all actually unrealized until you actually sell your shares, meaning whether or not your shares are worth a lot or little, that doesn't actually hit your hip pocket until you've actually sold your shares. And you can see when you look at the share price journey over the years, it's been high, it's been low, but if you had held on to it, you would have consistently gotten a dividend around $3-4 a share over that period. And that's what the little D's indicate is when a dividend was paid for Commonwealth Bank holders, and you get paid generally twice a year. So for me, if I was looking at this, my key takeaway would be if I wanted to earn more money on my money, it's better off in, say, a stable bank where it's earning dividends over time rather than necessarily in a savings account. And that's because I'm also comfortable with the risks associated with the investment value or the initial capital value maybe being worth less, but I know I'm holding shares for quite a few years, like over 10 years, and therefore I'm going to be quite comfortable that the value of those shares will go up above what I had initially invested in. Now, it'd be wrong of me to not clarify with you guys quite a few points around investing in shares and this whole comparison. So the first thing is the past doesn't predict the future, and this is especially the key when it comes to share investing. where just because the share price has gone up over the last few years or just because it's gone down over the last few years, it doesn't mean you necessarily keep doing that. And also in the case of dividends, just because the Australian banks have had a good run over the last few years and they've paid out relatively high dividends, considering we're in COVID and actually Commonwealth Bank recently reduced their dividend from $4 down to around $3 a share, the actual amount of money you may get in terms of dividends may also decrease as it compared to what it was in the last few years. So that's something to be aware of. Just because you saw certain performance in the share market over the last 3-4 years doesn't necessarily mean the next 3-4 years will be replicating what you saw back there. Now, the second thing is your capital value can go down to zero when it comes to shares. Now, this doesn't occur when it comes to your investment in your bank accounts. You put in $10,000, pretty safe that it'll be still $10,000 there after a few years. But there's no real guarantee when it comes to investments in the share market. So if you put $10,000 into buying shares in Commonwealth Bank, theoretically, that $10,000 can go down to zero. It'll never go below zero, like you'll never lose more than what you put into the share market when it comes to just buying and selling shares, but it can theoretically go down to zero. I mean, what circumstances would occur where someone like a large Australian bank would go bankrupt and go down to zero and all the shares will be worth nothing? I don't know, but theoretically it is possible. So that's a key risk to be aware of. Now, the third thing is I've actually used compounding in one case and not compounding in the other case. And what I mean by that is when it came to your money in your interest rate savings account, I assumed you were compounding your money. So you were earning interest and you were keeping that money in there so that you could earn interest on your interest and it would compound up. But when it came to the investment in the shares, what I've assumed is that people would take the dividend payment and they'd put that money aside. Now, what sometimes people do is they'll reinvest the money. So they'll get paid a dividend by Commonwealth Bank and they'll say, instead of giving me the cash, can you use that same money to buy more shares in Commonwealth Bank? Now, in this situation, that wouldn't have worked out great for you because you would have reinvested in Commonwealth Bank, but then the value of Commonwealth Bank shares would have gone down. But when you see these things on TikTok and Instagram where they say if you had invested $10,000 in 1955 and if you had held it and compounded it over 50 million years, you'd have $50 gajillion, that's all assuming you're using compounding options where they're saying whatever money you had earned in the share market would then get reinvested into the share market and it would keep compounding, it would keep building up and up and up. Now, the fourth thing is I haven't taken into account the impact of taxes. Now, this is important because taxes are pretty straightforward for money you would have earned in terms of interest in a savings account. You earn interest, that interest gets added on to your taxable income, and you have to pay tax on it as usual. Now, it's a little bit more complicated when it comes to tax and dividends and shares. And it's basically because you may have heard of this term called franking credits. And it's basically the Australian government's way of recognizing the fact that Commonwealth Bank has earned money. Then they've paid a tax on that money. And then of that, whatever's left over, then they'll pay that out to their shareholders as dividends. And what they're basically saying is we're recognizing the fact that if you include that money in terms of your taxable income, which you have to do, that's actually not optional, you do include it. The Australian government is saying, look, we acknowledge that tax has already been paid on this money, so we're not going to charge you tax again. So what they'll do is they'll attach something called a franking credit, which will help cancel out a bit of tax. Now, I've intentionally left out the impact of taxes because they'll naturally favor you having dividends and shares rather than you earning interest on your savings account. So for me, my key takeaways from all of this was, it's better to put money into being a shareholder of a company rather than necessarily being a customer of a company, especially if you can earn high levels of dividends from the company over a long period of time. Personally, for me, I do like that because I'm comfortable with the risk that the initial investment could go down, but I know over a long period of time, generally the investments into good quality companies generally goes up over a long period of time. As always, remember this is not financial advice. Please consider speaking to a financial advisor before you make any key investment decisions. But I hope this has given you a bit of insight into how money generally travels between being a customer and being a shareholder. If you enjoyed the video, please hit the like button. And if you have any questions, please leave them below in the comment section below. And please consider subscribing if you enjoy these videos. I generally do weekly videos on personal finance and investing with an Australian context. And I'll see you in the next video. Bye for now.